Good afternoon. Thanks very much for joining us today. This is Michelle Savage with XBRL US, and you are here for the webinar, The CFA Institute View on Standards, Why Structured Data Helps Issuers and Investors. Just a few logistical points before we get started. If you have any technical problems going through the webinar today, please email us at support, S-U-P-P-O-R-T, at xbrl.us, and we'll do our best to get you back up and online. We will be offering CPE credit for the program today. So at 2 points during the session, we'll be stopping to do a couple of CPE questions. If you are getting CPE credit, please be sure to respond to those questions and submit your entry online. And then we can get your CPE credit too at the end. Okay, I'm going to go ahead and get started and introduce our speakers today. We have with us Mohini Singh. Mohini is the Director of Financial Reporting at the CFA Institute, and then myself, Michelle Savage. I'm Vice President of Communication at XBRL US. And the purpose of our call today, or our webinar, is really to talk about the CFA Institute's view about standards. Just for those of you who are not that familiar with the CFA Institute is a global association of investment professionals. The CFA Institute offers the Chartered Financial Analyst designation, the Certificate in Investment Performance Measurement designation, as well as the Investment Foundation Certificate. Mohini, who has been involved in many of our programs in the past, is the Director of Financial Reporting Policy at the CFA Institute. Mohini represents membership interests regarding financial reporting and disclosure proposals issued by the FASB, the IASB, and many others. Mohini holds the Associated Charter Accountant designation, and today she's going to share with us some findings from a study about the costs of structured data, myth versus reality. So we're very happy to have Mohini with us today, and first she's going to go through the study, then we're going to take some CPE questions, and then we'll have a discussion with Mohini about the investor view of standards, followed up by some final CPE questions. As we go through the program, you can submit questions for Mohini by clicking on the Q&A link on your screen, and then we'll take those questions through the program. So with that, I'm actually now going to switch to another set of slides and turn the discussion over to Mohini, who is going to walk us through the findings from her study. Mohini.
Thank you very much for that, Michelle, and thank you for that introduction. As you just heard, I am with CFA Institute. As Michelle just said, what we are is a global not-for-profit organization of investment industry professionals. We actually have over about 135,000 members across 151 countries. The next slide, please. Michelle, the next slide, please. Thank you. As you can see in this slide, we have offices all around the world, in the Americas, in New York and Virginia, then in London and Brussels, in Asia, in Mumbai, Beijing, and Hong Kong. And we are currently seeking approval from our board to establish an office in Dubai. Next slide. What we are best known for is administering 3 levels of very hard exams. And once you pass those 3 levels and have 4 years of experience in the investment industry, we designate the CFA designation, that's Chartered Financial Analyst. Next slide. On the slide, you can see that 26% of our members are in fact analysts, research, corporate financial, investment banking analysts. Over the years, we've also moved into the advocacy arena to advocate for policy positions on behalf of our membership. CFA Institute has over 40 years of experience advocating for financial market integrity and transparency. One of the first advocacy initiatives was actually in financial reporting. And I am with the Financial Reporting Policy Group. And what we do is advocate for greater transparency in corporate reporting. Why was the group formed? Well, there was a sense amongst the analyst community that there was information that corporations actually kept track of that would be highly useful to making investment decisions. Yet that information was not required to be disclosed in the financial statements, and sometimes not even in the footnotes. There was a thought then that if CFA Institute would become more active in commenting on new proposed accounting and auditing standards or modifications to existing standards that were coming out at the time, that this would be beneficial for our membership because it will provide them more information for their analyses. What I am going to do today is to discuss the role of data and technology in financial reporting and why CFA Institute is advocating improvements in this particular area. Regulatory authorities around the world have adopted rules requiring companies to provide financial information in an interactive, machine-readable, that is to say, structured format. One such format is XBRL, Extensible Business Reporting Language. The idea was that this format would enable investors, including CFA Institute members, of course, to capture and analyze information more quickly and at a lower cost. Our 2016 report, as you could see, and we've provided a link for you on the screen, Data and Technology Transforming the Financial Information Landscape, illustrates the various benefits to investors of using structured data. It also outlines the various challenges that investors face in using structured data, including data quality and the excessive use of company-specific extensions that are not machine-readable. And of course, what does that do for investors? If it's not machine-readable, it actually hinders our financial analysis. We continue to address these challenges in various forums, including our participation in the XBRL US Data Quality Committee. The vision for structured data was expanded to include benefiting companies as well, not just investors. It was thought that with structured data, companies could automate their manual processes for assembling and reviewing information to prepare financial reports, saving them both time and money. According to the SEC, the mandate to adopt XBRL was introduced, and I quote, not only to make financial information easier for investors to analyze, but also assist in automating regulatory filings and business information processing. Interactive data has the potential to increase the speed, accuracy, and usability of financial disclosure and eventually reduce costs, end of quote. Yet despite being around for several years, XBRL has not achieved its full potential for either investors or companies. One of the primary reasons is that companies continue to see structured data as a compliance burden and a cost they must bear, and they have often shared these views with regulators. In fact, even our discussions with regulators have been focused on the issue of cost, and we have been asked for our views on the subject. So we undertook a study to examine the costs that companies large and small bear in preparing and filing their financial information in a structured format, and what can be done to mitigate these costs. Next slide, please. CFA Institute, an investor organization, seeks to address this issue so that all parties, be it preparers, regulators, or investors, so that they can all avail themselves of the various benefits of structured data. I'll go through the main findings of this report, but we've provided you with the URL so that you can read the entire report yourself if you wish. We certainly hope that this paper proves to be an educational resource for all parties in the information supply chain. We begin the study by examining what companies are saying about the costs associated with their XBRL filings. We then go through several case studies to demonstrate how, with proper implementation, large and small publicly listed companies, as well as nonprofits, can benefit from structured data. We maintain that the way a company implements XBRL reporting, that is to say, whether the work is outsourced to a vendor or done in-house by the company itself, directly affects its costs, and that cost reductions can be achieved by bringing the structured reporting process in-house. The current manual processes used by companies to assemble and review reports require time and money. These processes can be enhanced if companies standardize their data, of course, which may be housed across disparate data sources, if they can do this in-house and early in the reporting process. When data are standardized, companies can use disclosure management applications that can pull information from these disparate data sources to write automated reports, even the 10K, enabling the streamlining of current labor-intensive processes. Such standardization not only saves companies time and resources, but also reduces data errors because of less manual intervention. Next slide, please. However, companies continue to view structured reporting It's number 7, Michelle. The next one, thank you. However, companies continue to view structured reporting as a compliance exercise. As a result, most companies don't structure their data into a machine-readable format at the source, that is, early in the financial reporting process. Instead, what they do is they follow a 2-tier process whereby filers outsource the tagging of their data as an additional step after their financial statements have actually been prepared. And this is done simply to fulfill the regulatory filing requirement. Consequently, structuring is not producing the intended results. That is, 1, it isn't increasing the speed and frequency with which financial information is prepared, reported, analyzed, and used. And 2, it isn't reducing costs. In our paper, a case study about the Waco Corporation, which is a Japanese women's apparel manufacturer, illustrates the benefits of in-house implementation. Through a series of mergers and acquisitions, what happened was that the company had grown into 36 subsidiaries with 32 disparate legacy accounting systems. And unfortunately, these accounting systems did not communicate across platforms. And of course, this hindered the entire consolidation process. Various platforms, these included mainframes, mini computers, PC servers, created data that were eventually transferred to their financial system. To increase efficiency, what Waco did was to implement a consistent accounting information system across its subsidiaries by having the integration done through XBRL Global Ledger auto-journalizing software. We'll call this XBRL GL. What the software did was it converted the data to XBRL GL So this became a platform-independent solution, which permitted Wacol to concentrate on the data instead of on the operational systems and the platforms that created the data. Wacol now uses XBRL-GL to tag financial data from multiple legacy systems and to transmit the tag data for use in their new Oracle financial system. And this wasn't done recently. The company's 2003 implementation was actually very successful. XBRL-GL has become the backbone of the company's consolidation reporting of its 36 subsidiaries, real-time cash management. Before the new system, reporting was done once a day. The XBRL-GL solution has also reduced the end-of-cycle financial close by 2 days through the automation of information integration. We then moved on to a second case study. This was of United Technologies Corporation. UTC, their adoption of XBRL, and they also brought it in-house, shows that one of the principal reasons that the company had been tentative about the technology was because there were concerns about the resources required, including cost and technical proficiency. But they found that these concerns were misconceptions on their part. Indeed, the study demonstrated that not only were the costs not burdensome, but that applying the XBRL technology and automating many of the manual assembly and review processes eliminated 150 to 200 hours of labor from the quarterly reporting process. And finally, a third study, a 2011 case study of the Maryland Association of Certified Public Accountants. Now, this is a small nonprofit, shows how it came to use software tools to transform internal accounting financial data into XBRL and then repurpose that into multiple formats for reporting, analysis, and publications, all of it being done in-house. Such formats include the financial statements, but they found that nonprofits could also file their Form 990, their return of organization exempt from income tax, via XBRL. Doing so would turn a lengthy filing process into a very, very quick one. These case studies from different jurisdictions demonstrate that the proper implementation of structured reporting benefits all sorts of companies, large and small publicly listed companies, as well as nonprofits, by reducing costs and creating efficiencies. Next slide, please. The paper makes two further recommendations. Implementing the use of inline XBRL, that's iXBRL, and curtailing the use of extensions. Under iXBRL, all XBRL data are contained in ordinary human-readable files. Because a single iXBRL report can be viewed on a screen and analyzed by software, no viewer is required to convert an XBRL filing into a human-readable form, resulting in cost savings. CFA Institute also believes that regulators should curtail the current excessive use of extensions or custom tags that are not machine-readable and therefore hampers investment analysis. However, investors also definitely need information that is entity specific in order for it to be meaningful for their financial analysis. We thus believe it is necessary to allow for the use of company-specific extensions within a framework that restricts their use to very rare circumstances. And I think the way that framework should be set up is best put in one of our publications. Next slide, please. And it's called Extensible Business Reporting Language, a Guide for Investors. In it, we maintain, and I quote, individual extensions should be limited to those rare situations in which an item unique to that firm exists and the information about it does not fit into any of the concepts within the standard taxonomy or extension. We strongly encourage reporting companies to look first for the appropriate tag within the existing taxonomy before turning to a custom extension. If such a tag does not exist, we believe an extension should be allowed, but within a well-defined framework so that no extension corrupts other financial statement relationships. Simply put, the automated relationships required by the computer remain. When a custom tag is inserted, the relationships remain intact and the numbers continue to sum up correctly. Next slide, please. So what's our conclusion? We conclude that by companies focusing on how they implement structured reporting, that is, by bringing it in-house instead of using outside vendors to prepare their regulatory filings, implementing iXBRL, a form that is of XBRL that is both human and machine readable, and curtailing the use of company-specific tags, companies can reduce the costs they incur, and this will allow companies and users to benefit from its use. And why do we want this? Because the use of structured reporting results in greater transparency for regulators, investors, and other users. Thank you, Michelle.
Mohi, thanks very much. We're going to do some CPE questions, but first we have a question from the audience. And again, just a reminder that you can pose questions by clicking on the Q&A link on your console. So the question that we got is, have these in-house case studies revealed issues with XBRL accuracy? As these are in-house clients, it's likely that they may not be in touch with new guidelines like the new data quality committee rules.
It wasn't these particular case studies that revealed accuracy issues, but there are many others that do. And that's why we're working strongly with the data quality committee that XBRL US has set up to work on some of the quality issues. And what we have done through the committee is set up validation rules that we are strongly encouraging companies to adopt, to run the validation rules so that they can locate those errors before they complete their filing.
Great, thank you. Okay, we're going to go to a couple of poll questions first before we go on to the Q&A portion of our discussion today. So the first poll question, and again, this is for CPE credit, is how many levels of exams must an analyst pass to obtain the CFA designation? 2, 3, or 5? If you can please just click on the link. Oh, I have to launch the poll, I'm sorry. Okay. Okay, is it 2 levels, 3 levels, or 5? So please click on the appropriate link to record your answer. And we'll give this another 10 or 20 seconds or so here. Okay, I'm going to end the polling. And thank you for your responses. And we'll bring up the next poll question. And this question is, the CFA Institute believes that companies can reduce costs and benefit data users by 1, implementing Inline Xray All, 2, using more extensions in their company filings, or 3, outsourcing their Xray All preparation process. Please click on the appropriate link. Okay, I think we'll shut down that poll and go to our discussion portion of our webinar today. All right, thank you. We have a couple of additional questions, Mohini, so I think we'll do some audience questions before, and while you're answering these questions, we'll switch slides. So the first question, given that financial reporting for many companies is disparate, can you elaborate on how filers can limit extensions, which are machine readable, by the way?
There is a group that XBRL International has set up that is actually trying to find a technical way to make these extensions machine readable. I don't know if you want to add something about what that group is doing, Michelle.
Yes, it's a group that is, I believe it's XBRL International, and I believe the FASB is involved in that also.
That's right.
And, yeah, and basically, I think their goal is to help provide preparers with more guidelines on how to connect extensions with existing base elements from the U.S. GAAP taxonomy, and I think with that, we'll get more information there. And we at the Data Quality Committee are working on it as well. For example, one of the things that we found is that what filers are doing, for example, is that they are trying to make their XBRL filing look very much like their paper filing. And so they're creating extensions just to align those two, the machine readable filing and the paper filing. And so that's one of the reasons that we think that Inline XBRL will be great, because since they will be one and the same, create these extensions to make the two filings look the same. So there are many ways in which you can reduce extensions, and both the committees are working on developing guidelines to guide preparers on how to do that. Great. Okay, thank you. Let's go ahead and cover our discussion questions right now, and we'll come back to some of the Q&A that we've received. So the first discussion relates to structured data in general, and actually the CFA Institute has been very supportive of the use of the standard to create structured data. What would you say are the key attributes of tag data that you think make it most valuable for investors and analysts?
Well, one of the reasons that we've always supported XBRL is because we believe that it will lead to the democratization of information, right? And this goes back to before XBRL. Anything that goes in that way, such as the development of the Edgar system, we thought that it would, and it did, lead to democratization of information. That's the 30,000 foot in the air answer. For analysts and investors, why is structured data valuable? Because data is integrated into any of their analytic applications. It makes the data more searchable and comparable across time and across companies. And we found that if you do indeed have a robust, well-defined taxonomy, it will provide for greater precision and comparability than any text format, right? And my final point would be, and it perhaps is the most important one, is that it also provides, which is very beneficial for investors, the amount and granularity of data that you get. So just to illustrate that point, PwC actually did a review of Morgan Stanley's 2013 10K. And they found that the Bloomberg data set had 170 elements. XBRL data set had over 7,000 elements. That's a lot of information that's very useful for analysts.
Great, thank you. Thank you, Mohini. Companies today are required to file in XBRL form, they're required to file financial statements and footnote disclosures. But there is a lot of other information like the MD&A, the proxy statement, the earnings release that are still filed strictly in text or HTML. Are there other types of data that CFA Institute thinks should also be in structured XBRL format?
If you go to the first report, which we provided the URL to, and it's called Data and Technology Transforming the Financial Information Landscape, we actually set out our vision for the future, and that is for the broader and the deeper use of structured data. So we believe that structured reporting is most effective when it's applied to broadly to all aspects of reporting. That is to say, like you just mentioned, earnings releases, all regulatory filings, proxy statements, etc. We also believe that structuring needs to apply not just to all forms of reporting, but also to all companies. The reason I bring up this point is because there have been discussions in different jurisdictions of smaller entities not using structured data in their filings, and we urge not to do it this way because it prevents the automated analysis of those companies. And don't forget, investors invest in companies of all sizes, big and small. Finally, I would say that we need it to apply to not just the financial statements, but to footnotes and a lot of very rich information that's there in the MD&A. And so we strongly urge regulators to require text block tagging of the information in the MD&A.
Great, thank you. Next, I'd like to turn to some of the recent SEC proposals. There have been quite a few over the past year that involve the use of structured data. For example, in March 2017, the Commission proposed that companies be required to switch from conventional XBRL to Inline XBRL, which is the specification that Mohini spoke about earlier. Inline XBRL, as Mohini mentioned, effectively combines an HTML and an XBRL document into one. That makes it both human readable as well as computer readable. So that proposal has not yet been finalized one way or the other, but many members of the analysts and data community have been very supportive of Inline XBRL. And in the findings from your study, Mohini, you note that Inline will help reduce costs for issuers. Are there other benefits of Inline XBRL for issuers or for analysts? And why do you think the SEC has proposed a requirement that Inline XBRL replace conventional XBRL?
Well, I'll take your question from last to first. I think the SEC has done it because many parties, such as ourselves, have gone to the SEC over here and to ESMA, the European Securities and Markets Authority, saying that we think that this would be beneficial to both companies and to investors. And we've made the arguments to both, and that's why ESMA, in fact, is going to be implementing Inline XBRL from 2020. For companies, I think it reduces the burden on companies of having to file two separate documents each quarter. And so by taking away these dual filings in PDF and XBRL formats is going to be beneficial for them. I think it'll also help companies by once you have the XBRL data actually embedded into the HTML document, it minimizes the effort and the time required to review these documents. The point I made before, some filers currently spend unnecessary effort trying to get the XBRL rendering to look like the HTML, and sometimes either resort to incorrect tagging or resort to creating extensions to do this. So it will get rid of that problem as well. And the SEC fact sheet says this: Inline XBRL would give the preparer full control over the presentation of XBRL disclosures within the HTML filing. I agree with their statement. and of course, it will benefit investors, and those are the constituents we are most concerned about. We think the dual filing is not helpful to them because there may be errors or inconsistencies between the PDF and the XBRL filing. We also believe that if you have the annual report that's only available in PDF, that having these two different versions is likely to be helpful to because they'll just stick with the PDF because that's what they're comfortable with. And I also think that and of course, because the single inline XBRL document is machine readable and cannot be automatically consumed without the need for a viewer, that helps investors too.
Great, thank you. There was another proposal that the SEC published last year in October called FAST Act Modernization. And as part of this proposal, the SEC suggested that companies would be required to file the cover pages of their financial statements in XBRL. Does the CFA Institute have a view on that? Do you think that that kind of data would help investors?
We went through the FAST Act proposal and we agreed with the suggestion that they would tag the cover pages of filings, which is the 10K, 10Q, 8K, 20F, because we think that it would improve the searchability and the usability of the filings. And, we think this can actually be done with minimal effort on the part of issuers because they're already required to tag quite a lot of that information already. We also support the proposal that inline XBRL should be the standard used for the tagging of the cover pages. Unless, of course, by that time, the Commission has not adopted inline XBRL as a mandatory requirement, then we suggest that they use traditional XBRL. They also had a proposal to require that the trading symbol each class of registered securities. And we think that this should be, we also agree with this proposal that they came up with, because it'll be all of this, it becomes more functional, it increases the functionality.
Mohini, you're cutting out a little bit every once in a while. I'm not sure if you're moving away from the speaker.
I'm sorry, is this better?
Yes.
Okay.
Yes.
And while we've agreed with these particular proposals that they've come up with, we'd go back to what we had said in our vision in the first document that I was talking about, that we want them to require structuring of all of this information across all regulatory filings. And in fact, we went through the XBRL US comment letter, and I really liked a statement you guys made, and I quote, "Any data that is considered important enough to be required within SEC filing should be provided in structured format to enable automation of access to that data."
Okay, great. Let me take a couple of questions that we've received from the audience, Mohini. There are some that say that the SEC is pushing inline XBRL because conventional XBRL is a failure that hasn't really produced any benefits for investors. And it's been a burdensome government overreach to registrants. Do you have any thoughts on that? I mean, do you think that it's a burdensome overreach for issuers? And do you think that it's really not benefiting investors?
I think it is benefiting investors, but the problem is with all of the data quality issues that you have seen, it goes back to why we wrote that paper to begin with, that what can we do to reach the actual potential that XBRL has, because it hasn't achieved its true potential. And a lot of it has to do with data quality issues that we believe will be overcome with the use of an inline XBRL, because there's some really low-hanging fruit over there. Just the use of the incorrect use of negative values or scaling errors. All of these, we believe, will go away with inline XBRL. And so, yes, traditional XBRL has had its problems. Inline can get rid of some of those issues. It can't get rid of everything. So consistency of tagging across organizations, the Inline can't do that. What we need for that is more guidance to companies, guidance that maybe the data quality committee could issue that would help companies identify the appropriate tag so that we have more comparability across firms.
Okay. The FAST Act proposal also had a proposal that legal entity identifiers be required to be filed by companies that have LEIs, legal entity identifiers. And an LEI, just for those who aren't familiar with it, is a 20-digit alphanumeric code that provides unique identification of legal entities. It's a global identifier. It's used in many countries today. What is your view, or what's the CFA Institute's view on the LEI? Is it still helpful to investors if only a subset of companies report the LEI? And is it helpful in general, Mohini?
We actually believe that requiring all companies to maintain and report the LEI of the registrant and major subsidiaries should be the ultimate goal of the SEC, because we think that it would increase investors' ability to identify and analyze the risks of the registrants and their subsidiaries. But that's a normative view. We think that taking the initial step of requiring only those that currently maintain an LEI to report it, as is being proposed by the SEC, would be beneficial to the marketplace and would impose minimal burden on registrants. As you just said, it's a global identifier being adopted by regulators worldwide. It's freely available for investors and regulators to use. We would recommend that the SEC go a little bit beyond what it's proposed and that the LEI be used by all companies, large and small, because over time, the structure of a company will change and it can be tracked through its LEI. And we also believe that the LEI should be used in additional areas throughout the filing to aid investors. An example of that would be when a company refers to another legal entity, it would be appropriate to reference its LEI.
Okay, great. I think we have a couple more questions from the audience, Mohini, which I want to cover before we go on to the next topic area. One question came up about extensions, and the CFA view that extensions should be limited. And the individual says XBRL extensions in the U.S. are machine readable. Can you address the fact that they're machine readable, and how does that factor into the need to curtail them? If they are machine readable, why is that an issue?
The problem is it's not machine readable everywhere. And we take a global position, obviously, on that.
Okay. Okay. I'm just looking at questions that we're getting here. Question, do you have case studies that show that the XBRL data is comparable across jurisdictions? For example, if the data from a Japan-based company is comparable with a US-based company, given that they both use the same accounting methods?
I do not, but I'd be surprised if you would find, I would have to actually look into it, but I'd be surprised if you find great comparability across jurisdictions, because, for example, in Japan, extensions aren't allowed. And so whereas they are allowed over here. And in fact, in Japan, what happens is if a company puts in a request to require an extension, then it either becomes a part of the taxonomy or it doesn't. So there are no extensions. I think that itself, because the rules are different, I think there would be comparability issues.
Okay, and here's another extension-related question. For tagging disclosure notes to financial statements, do you think that regulatory taxonomies should include as wide a range as possible of XBRL tables that fit tagging requirements for common practice disclosure of notes in order to avoid company-specific extensions? So the idea is, should we expand the taxonomy to cover as many elements as possible so that, or to add elements so that that would limit the number of extensions that people use? Do you think that makes sense?
Well, isn't that what the FASB is currently doing? But the problem is that they have come up with a huge taxonomy, right? There has to be a limit to it. It's a balancing act, because what they're doing here to overcome the problem is just going on and on increasing the taxonomy. Whereas if you look at the IFRS taxonomy, on the other hand, it may be too limited. So it's a balancing act.
Okay, and another question is about individual investors. How do individual investors benefit from XBRL, or do they? Do they have access to this data?
Of course, they have access to it. Are they benefiting as much as institutional investors? No, of course they are not. But don't forget, I mean, the individual investors are more price takers rather than price makers. It's the institutional investors that are the price makers, and so they are the ones who are going to delve into this data.
Right.
It also, the reason it's important to have the data for the individual investors is because their financial advisors are the ones who are going to be using it.
Right, and like if you go to Bloomberg or Morningstar or some of these data providers, they're using XBRL data, and so they're creating XBRL data and serving it up to their clients who are individual investors. So individual investors, even though they may not even realize that they're using it, they may be using XBRL data because they're using it from another service provider. And we're actually seeing, because of XBRL, we're seeing that there are more data providers entering the world of financial data. A lot of small startups, because they're able to take the automated computer readable data and provide analytical frameworks for that data much more easily than they have in the past, because previously it really required establishing a whole team of people to database the content, and now that's much more limited. So that's another thought in terms of individual investors. So let me go on to our next topic area, which is about a little bit more about technology. And investors obviously use lots of different types of technology. How important is it for investors to keep up to speed or adapt to technology changes? What impact does technology have on the analytical process?
Well, let's take a look at the analytical process. It really impacts the allocation of time.
Mm-hmm.
Spend more time on analysis rather than the collection of data. It, of course, improves the accuracy of the data because you avoid all those fat finger errors. And what these two things allow investors to do is to either take a deeper look into the companies that they're already covering, or look into perhaps the smaller companies, the mid-cap companies that they weren't previously covering. So it allows the analyst to make a more informed decision and provides greater investment to companies that they weren't following previously.
Mm-hmm.
As for why investors need to follow the changes in technology, because if they don't, then how are they going to provide input to the regulators as to what they need? If they want earnings releases and all of their regulatory filings to be in a structured format, or the MD&A, then they need to keep up with the advancements that are being made all the time, frankly.
Okay, let's go on to the next question, which is about technological advances. And there have been a lot of late, in the fintech arena, like blockchain, crowdfunding, XBRL, of course, artificial intelligence. What would you say are some of the biggest technology advances of late that have had an impact, both positive or negative, on investors and analysts?
Well, you're probably referring to the financial reporting arena, but our members are investment professionals. So when we asked them that in a survey, what they told us was that they believe robo-advisors will have the greatest impact both in the short term and the medium term, that is, over the course of the first of 1 year and over 5 years. They believe that 70% of them believe that investors will be positively affected by automated financial advice tools in the form of reduced costs and improved access to advice and improved product choices. The second technology that they thought that would have a large impact over a medium-term period was blockchain technology. And of course, the distributed ledger, as you know.
Right. Yeah, I think that's going to have a big impact. And actually, one of the questions that we received is XBRL built into blockchain discussions or technology? So is there any link between XBRL and blockchain? And one of the things that we at XBRL US have looked into are things like smart contracts, which a smart contract is basically a digitized contract that that may have a trigger that's triggered by data, by new data being produced. And we think that smart contracts and XBRL could definitely be tied together on the blockchain, and using XBRL data as a way to trigger basically covenants and things in contracts that. So that's something that we're exploring on our side, although obviously in very early stages at this point. So the next question I have is, do investors and analysts have any reservations or concerns about new technology or standards? What might be the downside, if there is any?
Well, if I could take a totally different example to illustrate the point I want to make. There are both benefits and we have to be, and there are concerns. So crowdfunding is a great example. It provides tremendous benefits. It provides a safe harbor from some SEC rules. It has the potential to bridge a funding gap for small businesses and entrepreneurs. But there are dangers, because you have citizens who become direct lenders or investors to these companies who don't have all the knowledge or experience that they need. And why do they need protection? Because, as we all know, a majority of new ventures fail. So in implementing any type of new technology, we really need to ensure that we're striking a balance between providing investment opportunities and investor protections. And the same is the case with XBRL. It can provide a lot of benefits to investors, as I've said, improved accuracy allows them to spend more time on analysis rather than the collection of data. But there are all the data quality issues associated with XBRL. And so because investors are concerned about that, they've actually told us that they actually want some form of assurance over the XBRL data that they received. And we had a survey, and in fact, it was 77% of respondents who said that they want assurance over XBRL data that's filed. Okay, great.
Okay, I have one last question, and then we'll probably go to some CPE questions here. But and this relates to something that XBRL International is doing. XBRL International, which as you know, is a nonprofit standards body responsible for maintaining the XBRL specification, has initiated a program that's called the Open Information Model. And this group is working to expand XBRL into other formats. So traditionally, XBRL has been based on XML, Extensible Markup Language, but it's being expanded to effectively kind of debundle the standard from its underlying format and create versions that can be based on not only XML, but also JSON and CSV. And the objective of this is to make XBRL more accessible in more platforms, while at the same time retaining the benefits of a free and open global standard that's uniquely designed for financial data. From the perspective of the CFA Institute, does this expansion of the standard into other formats like JSON or CSV, does it have any impact on the investment community, positive or negative?
To be honest, Michelle, this isn't something that we've spoken to any of our members about, but we believe that insofar as it provides greater accessibility, in more platforms, it will be beneficial to analysts.
Okay, great. Okay. Okay, well, that's, I think at this point, I'm going to go to some CPE questions, and because we're running up at 5 minutes to the hour. So let me just go to the polls right now, and we're going to do some CPE, our final 3 poll questions. Okay, and the first question here is, the XBRL Open Information Model now makes XBRL available in which formats? In XML, JSON, and CSV, in XML only, or in JSON only? So if you can click on what you think is the most appropriate response. So we'll take just another few seconds here to complete this poll before we move on to the last poll. Okay, I'm going to close down this poll. Right, and let's move to our last poll of the day. Which definition noted below best describes the LEI, the legal entity identifier? Is it 1, an identifier that is used to connect individual securities to corporate ticker symbols? 2, a 20-digit alphanumeric code that enables clear and unique identification of legal entities participating in financial transaction? Or 3, a 10-digit number used exclusively by the SEC to identify corporations and individuals who file with the SEC? So click on the response you think is most appropriate in order to get your CPE credit. And also, for those who are getting CPE at the end of the program, within the next 2 weeks, you'll receive something in email that's your certificate for the CPE credit. And let me just, while we're waiting for this poll to close, I'm just going to glance through and see if we have any additional questions. One question that we received, I'm going to end the polling here, so thank you all of you who responded to that. And Mohini, don't have any more of our prepared questions, but I did get one question. Are there any case studies of XBRL and blockchain being deployed together? Are you aware of anything like that?
I'm afraid I'm not.
Yeah, I don't think that there are any that I'm aware of, although we are actually looking into creating some smart contract pilots, and that's something that we'll be working on sometime in the future. Okay, well, I'm going to go ahead and we did our CPE question. And I'm just going to mention some upcoming events that we have. We have XBRL tagging in IFRS, which is taking place January 31st. And we're going to have speakers both from the SEC and the IASB. And that's going to be moderated by Rob Blake with Certant, who is a member of XBRL US. And you can register at this link here. And again, we'll be offering CPE for that program, and it will be a free webinar as we usually do for these programs. So I want to thank Mohini Singh very much for spending time with us today and sharing insights into the myth and reality of XBRL tagging and the costs of tagging and how investors, analysts, and issuers can benefit from XBRL.
Thank you very much, Michelle.
Thank you very much, Mohini, and thanks to everyone for joining us today.